Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association. Statements may reflect the opinions, estimates, and current projections of Aegon USA Investment Management LLC as of today and are subject to change. Such statements are intended for airing exclusively by the sponsor to invited participants on this call. The discussion includes no recommendation to buy, sell, or hold any specific security and should not be considered as constituting investment advice. Past performance is no guarantee of future results.
This is Conversations, the official MTA podcast series, and today's guest is Dave Halfpap. Dave Halfpap, CFA, is Head of Investment Strategy, Aegon USA Investment Management, and Co-Head of Global Strategy for Aegon Asset Management. In his current role, Dave is responsible for leading the macroeconomic and market analysis as it relates to the economy, interest rates, and relative value of all fixed income asset classes. Dave is also responsible for the quantitative strategy, rates, and money market teams. Dave is a member of the Asset Management Group and Pension Investment Committee with the asset management experience spanning equities, high-yield bonds, and investment-grade corporate bonds. Dave is a member of the CFA Institute and former director of the Iowa Society of the Institute. Dave earned a BS in accounting from the Iowa State University. Dave joined Aegon in 1975. Welcome to the program, Dave.
Thanks, Lance.
So, tell me about your background, Dave. I see you started out in accounting. What attracted you to the financial markets?
Well, it seems like this was just yesterday, even though it was now, I guess, 37 years ago. But yes, I was an accountant at a finance insurance company, and at the time they had a promotion of someone to head of investments, and they also lost one of their analysts, and I was approached by one of the other people as to whether or not I wanted to get into the investment business, and I said, well, I don't know anything about it. Didn't study for that in school, and they said, well, that maybe is a plus. You can teach it to yourself. So I got into the CFA program, worked a lot in the equity part of this whole thing. So my journey started out as an equity analyst for about 4 years, was an equity portfolio manager for 10, high yield manager for 9, a portfolio manager of all of these classes in terms of asset allocation for a lot of our major insurance company portfolios, and now the past 2 years as the head of strategy. So back when I started this whole equity thing, and the person that was my mentor at that particular point in time was pretty big into technical analysis, so I obviously took that up, and it now plays a pretty strong role in the discipline process that we put in place for investing here at AUIM.
Now, you currently use 6 major factors of market discipline. Can you talk more about that and how technicals fit into that model?
Sure. Yeah. First of all, let me give you the 6 major factors. They're valuation, risk appetite, positioning, technical/momentum, sentiment, and the macroeconomic backdrop. Now, first, let me emphasize that this is not a black box. We instead refer to it as an encompassed discipline. So over the last 35 years, virtually any challenge to the markets we think can be analyzed within this framework. So we try to separate the noise out of the market and really look at just what we think is very important. In these 6 factors, they're not equally weighted, but rather, depending on the circumstance, each factor can have more influence depending on what kind of time period you're in. Technicals are used a lot of times to confirm what we're seeing in valuation, risk appetite, and positioning. And a lot of times it can be a leader to that, other times it's confirmation. But it's not uncommon to find where we'll have a significant amount of bearish sentiment, we got good valuation, you got bottomed out risk appetite, and everyone's positioned on the sideline, and you have technicals becoming more constructive. In fact, that's exactly what we like to see at major bottoms. you throw in a tailwind from the Fed, you have what we call then a sixfecta, where all six of these things are basically screaming at you that you need to be all into the markets in terms of risk assets.
Does that take a lot of convincing when you see everything pointing that way? Because that's got to be the hardest time to pull the trigger.
Absolutely. And it's conversely at the other side, at major tops. It's going to be exactly that same sort of thing. The one thing that I've found, at least in the way we address the markets and employ our discipline, is it's a very lonely discipline because you're making these changes at major inflection points, and you're going to be sort of a lone wolf, and you're going to be regarded as being a little crazy at times with your thought processes and what have you, but it's the way that has worked for me and has worked for our organization to make money for our clients.
Let's talk about the sentiment components of your 6 major factors. I know you've long been a student of sentiment indicators. What indicators do you look at, and have you found a unique sentiment indicator that you like?
Well, we used to follow trend an awful lot, TRIN, and fortunately, given the makeup of the market with a lot of closed-end bond funds, high frequency trading, all that kind of stuff, it's sort of lost its relevance over the years. The one sentiment indicator that we follow currently pretty heavily is the Ned Davis Crowd Sentiment Poll, which is just a conglomeration of 5 or 6 sentiment indicators that are pulled right out of Barron's every week. So what's interesting is that we use that as sort of our lead sentiment indicator, but what you're going to find is that everything else kind of plays into it and becomes a sentiment indicator on its own. So if you've got very bearish sentiment in the marketplace, you're probably going to have valuation confirm it. You're probably going to have risk appetite that's been risk off over the last number of weeks, if not months. You have positioning where people have positioned themselves to be risk off. All of those things sort of in themselves then manifest itself into a sentiment position in the market, which we then try to go contrary to.
Okay. Let's talk about a great market call you had back in 2007. Your portfolio is roughly $35 billion at that time. Is that about right?
Yeah, that was the specific life insurance company portfolio that I managed.
Okay. And about what period of time did you start getting defensive, and what tools were you using to get concerned about the economy and the market, and when did you start taking risk off the table and getting defensive at that time?
Well, if you recall back to the 2005 through early 2008 period, it was a period where spreads had tightened versus treasuries to just an unbelievably tight level. And that was driven by a lot of things, securitization, leverage, what have you. Well, so we had a significant overvaluation going on in risk assets at the time, and you really weren't getting paid for it. So in early 2007, I started buying treasuries within the portfolio, which was sort of unheard of because, well, we normally don't do that because it's not enough yield, and it's like, well, maybe you may think about it differently down the road if what I think is going to happen does happen. But when you looked at everything else, risk appetite was off the charts, positioning was off the charts in favor of risk assets. You weren't getting paid to take that risk. And then we were starting to see some technical things showing, some caution up there. But we also, from the position that we were in, were able to look at a lot of the deals that were being done in the securitized world, and we were just looking at these things saying these were just going to end badly because they just didn't have good collateral underwriting those. And so that's what continued to convince me to go on and continue to put about a 10% weighting of treasuries in our portfolio. And I was even more than convinced in the first month of January 2008 when a lot of long-term momentum indicators gave sell signals on risk assets, namely equities. And that really confirmed to me at that point in time that we were on the right track. We knew that something dramatic was probably going to happen in terms of a bear market. We just didn't know at the time how dramatic that was going to be.
And you said January 2008, so that was before Bear Stearns
Yes.
event happened.
Yeah.
Wow. Okay, so you were concerned even then.
Right. We had significantly de-risked up until that point in time, but then we're pretty much convinced about that in early '08, which the technical indicators helped us become more convinced of.
Let's talk about your toolbox, your technical toolbox. You've been known to send out charts of head and shoulder patterns, potential head and shoulder patterns, weeks ahead of any analyst at major investment banks or before anybody on CNBC ever talks about it. Is the head and shoulders one of your preferred patterns? What are your favorite indicators that you use on your charts? Give us a peek into what you look at when you pull up a chart on your computer.
Well, in terms of pure charting, I'm still consider myself somewhat a novice with this compared to a lot of your readers and listeners out there who probably look at a lot of different patterns. I've over time just become comfortable in reading and seeing various things like head and shoulders or double tops, but they're also then confirmed by either MACD or stochastics. So what I'm always looking for is the markets where it's grinding higher, but all of a sudden it's not confirming underneath with various kind of indicators like bullish percent index or percentage of stocks above their 200-day moving average and the like. So that's kind of how I'm looking at this, and then I sort of then take a peek at what's going on over here with all these other 6 factors, and that's how I then sort of come to our conclusion of what our outlook is based on all that put together.
Sure. Let's talk interest rates. The 30-year dropped as low as almost 2.5% this month, and the 10-year went below 1.5%. How low can interest rates go?
Well, that's an interesting question. It's one that's plagued a lot of people. They can go as low as however rationalized people want to have it, whether or not they think that's an attractive place to buy. There's a lot of different things that are at play here. Obviously, everyone knows that you've got the big elephant in the room of the Fed buying treasuries. Now we've got another extension of Operation Twist from the FOMC meeting yesterday. There's other things that are at play here. There's the liability-driven investing program that's involved with pension plans. There's risk parity that's out there. We're even seeing potentially out of the Frank Dodd bill that there may be a big bid for treasuries due to the fact that they're going to have to maybe have collateral backing all these derivatives that are on the books, and that namely is either cash or treasuries. So there's a significant bid. So we believe that a lot of the fall in interest rates that have happened over the last couple of years are due to demand technicals, if you will. And we actually think that what will happen if rates were to go back up, most everybody believes rates are going to go higher. That's something that does concern me in some of our sentiment indicators, because everybody believes rates are going higher. But if we get into a point where rates actually do move higher, it may not be due to fundamentals. It may be due to the unwinding of a lot of these other demand technicals. if they in fact have taken us down to a level that doesn't seem sustainable due to technicals, it's probably going to be the demand technicals that wear off and lead rates to go back higher. So, but you just have to look at all of this with an open framework and an open mind. Everybody has been fighting falling interest rates for 30 years. I've been at this organization for a long time, and it's just everybody's always believed that rates were going to eventually go back up, and that's just been the wrong stance for a long period of time. About the point in time when everybody gets rationalized in their mind that buying a 10-year at 1.6 yield is quite attractive is probably the time you want to step back and ask yourself, does that really make a lot of sense?
Mm-hmm. Do you have an equity market outlook that you can share with us today?
Sure. We're cautiously optimistic in the short run. Valuation is kind of okay. Risk appetite rolled over in April, so it's kind of out of sync right now. Sentiment is obviously bearish, so therefore we look at it bullishly. Positioning is slightly bullish, and the technicals are still kind of working toward becoming positive. We still have long-term technicals that remain in place, that is momentum, but we had saw some of the short-term and intermediate-term stuff kind of become questionable in the last couple months, but we're seeing that now heal. And we're most likely going to see more Fed help if we need be. So that makes us cautiously optimistic. What I'd like to point out is to give you a little bit longer run forecast of something that we're doing some work on that I think is quite interesting for what we think is setting up as a mega bull market in risk assets. Everybody knows the term risk on, risk off, and it's been in vogue in the market over the last couple of years, but it's really not that new. If you really look at risk on, risk off, it's been out there and been going on since the year 2000, with both retail investors and institutional investors both becoming significantly underweight equities. And the rationalizing, because of all of the concerns that we read about every day, that underweight is rational to be there. So you have everyone that wants to now be this asset allocator, which has taken them really over a decade to find that out, when in fact you should have become an asset allocator probably in early 2000. Mm-hmm. Sometime in the next few years, we think we're going to see this tectonic shift back where asset allocation will eventually fall out of favor and buy and hold will become much more the norm. And the obvious question there is who's going to power that next mega bull market? Well, we think it's the current retail and institutional investors that are now underweight equities and are in what they believe is a more riskless asset, that being treasury bonds. So it's a really long-term view. I can't tell you when or if that thing is going to start anytime soon, but I can see all the makings of this setting up to where we're going to get to a point where, yeah, I feel really good about being risk averse. And then as we slowly heal the things, we get a solution in Europe, we get some solution to our own budget issues in this country, we get more on a growth kind of a path strategy. You just, all of a sudden, prices I think could work themselves higher, and that will then be fueled by everybody that's sitting over in a risk-averse portfolio.
Dave, with over 37 years of market experience, you've seen many business cycles and market cycles. What advice do you have for the young technician and the young analyst in the market today?
You know, it's really pretty simple. You need to read a lot and you got to work hard. Technical analysis, I've found, is hard work. You've got to look at a lot of charts time and time again to hone your skills. And it also helps hone your discipline. Without one, that being a discipline, you're going to be lost in this business.
Where can we read your research?
We currently have our website out there. It's called aegoninvestments.com. That's AEGON investments.com.
Excellent. Is there
And
anything
on that website under Outlook, you will find all of our views on rates and the economy and relative value and the like.
Excellent. Is there anything you'd like to add before we close?
No, thanks for having me today. I've enjoyed this.
Oh, it was a pleasure. Today's guest has been Dave Halfpap, and that concludes today's MTA podcast. From Lexington Capital, LLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.